everyone. On behalf of Phillip Capital India Private Limited, I welcome you all for Escorts Q3 FY19 earnings conference call. I also take this opportunity to welcome the management team from Escorts Limited. Today we have with us Mr. Bharat Madan, Group Chief Financial Officer, Mr. Shenu Agarwal, Chief Executive Escorts Agri Machinery, Mr. Ajay Mandar, Chief Executive Escorts Construction Equipment, and Mr. Dipankar Ghosh, Chief Executive Railway Equipment Division, along with the Investor Relation team of Escorts Limited. We would start the call with a brief opening remark from management, followed by an interactive Q&A session. Before we start, I would like to add that some of the statements that we make in today's discussion will be forward-looking in nature. At this point, I would request Mr. Madan to make his opening remarks. Over to you, sir.
Thank you, Nitesh. Ladies and gentlemen, a very good evening to you all. We are giving the snapshot of the company's quarterly performance, which is as follows. The revenue for the quarter is up by 37.4% at rupees 1,655.1 crore, the highest ever quarter revenue as against rupees 1,205 crores last year same quarter, led by volume growth across all three businesses. Tractors volume up by 36% to 25,743 tractors as against 18,930 tractors last year same quarter. Construction equipment volumes up by 30% to 1,413 machines against 1,087 machines last year same quarter. EBITDA at rupees 200.5 crores against rupees 145 crores last year is up by 38.2%. EBITDA margin now stands at 12.1% versus 12% last year same quarter ended December 17. Finance cost by rupees 1.7 crores to rupees 4.3 crores as compared to quarter ended December 17. However, the total debt outstanding as of December 18 is rupees 239 crores. It's increased due to increased working capital requirement during this high growth festival season. This quarter we have an exceptional income of rupees 10.91 crores on account of transfer of our rough terrain crane business to the joint venture with Messrs. Todano Limited on a slump sale basis, net of value of asset transferred and associated costs incurred for effecting the business transfer. PBT from continuing operations after exceptional items at rupees 210 crores is up by 62.2% as against rupees 129.5 crores last year same quarter. The company reported a PAT of rupees 140.1 crores versus rupees 92.0 crores last year, up by 52.3%. PAT margin now stands at 8.5% versus 7.6% last year in quarter ended December 17. Just for the information of all the investors, this has been the highest ever profit the company ever achieved in a quarter in the history. So that's something which is a stupendous performance. The EPS for the quarter is reported at 11.72 rupees against rupees 7.70 last year same quarter. Now moving on to the segmental business performance. Starting with the agri machinery business, domestic tractor industry volumes grew by 19% to 2.17 lakh tractors as compared to 1.82 lakh tractors last year same quarter. Our domestic volume went up by 34% at 24,720 against last year's 18,418 in quarter ended December. Industry in our strong markets in North and Central India grew by 29%, whereas industry grew by 6.3% in opportunity markets of South and Western India. In line with our guidance, we have gained market share across all major states. Our domestic market share stands at 11.4% in quarter ended December 18, up by 130 basis points as against last year's same quarter. During the quarter, our product mix has been adverse, having sold more products in less than 40 HP category against last year. Besides, Farm Track and Power Track brand mix during quarter was at 36 to 64 against 37 to 63 last year. That has also marginally affected EBIT margin for the quarter, which now stands at 14.3% against 14.6% last year. During the quarter, we have added 47 new dealers in India, taking a total dealership count at the end of the quarter at around 920. We expect domestic tractor industry to grow by 10 to 12% in the current fiscal. Coming to the construction equipment business, our served industry grew by 19.4% in Q3 FY19 with respect to Q3 FY18. Material handling segment have been the biggest gainer in Q3 FY19 with growth of 35%, followed by compactors and road segment with 26% growth and backhoe loaders with 16% growth. Our total volumes in manufactured and traded products went up by 30% to 1,413 machines in quarter ended December 18 against 1,087 machines in last year's same quarter. EBIT margin for Q3 ended December 18 is at 3.5%, up by 127 basis points as against 2.2% in same quarter previous fiscal. In line with our strategy to move our products up in the safety value chain, during the quarter in Bauma Con Expo 2018, we have launched 3 new products, namely Hydra NXT13, the next-gen Hydra pick-and-carry crane with better maneuverability, high stability, deck utility, and better visibility. EC3664, a mini compactor in 3-ton class, powerful mini compactor with highest gradability and sturdiness, and EC5511, a compactor in 11-ton class. Going forward, we expect that our served construction equipment industry will continue to grow at 13 to 15% in medium term. Coming to the railway division, revenues at rupees 96.6 crores in quarter ended December 18 are up by 34.1% against rupees 72 crores last year same quarter. EBIT margin is up by 690 basis points at 19.9% as against 13% last year same quarter. Going forward in current year, we will be executing orders for new products with more import content, which may lead to some adverse impact on margins in short term, though in the medium to long term we will be able to mitigate the impact with gradual localization of these components. Order book for this division stood at more than rupees 450 crores as of 31st December 2018, which will get executed in next 13 to 15 months. Now I request the moderator to open the floor for Q&A session, please.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question at this time may press star and 1 on your touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the questions are assembled. To ask a question, please press star 1. We have a first question from the line of Jinesh Gandhi from Motilal Oswal Securities. Please go ahead.
Hi, sir. Congratulations on good numbers. My question pertains to 2 things. First is, in terms of our RM cost, it has gone up substantially on QOQ basis. So apart from mix, is there any other factor which has led to this? And can you also talk about the price increases which we have taken in tractors?
So there are 2 reasons for this actually, or if you look at quarter-on-quarter performance. One obviously is the inflation, because what is happening is in the last 1 year, if you look at the kind of inflation we have seen on the material cost side is almost 5.5 to 6% range. And we've been able to pass on the impact to the market, but it's been passed on in absolute amount. So that also impacts the percentage of material cost. So if you compare really against last year, so there's an impact of almost 1.5% earning out of passing on the inflation, some with a lag and some obviously because we're passing on the same amount, not in the same percentages, which is impacting the margin slightly. The second impact, obviously, like you mentioned, is about the mix, because we have some also subsidy-based orders which have been executed during the quarter, which is good top line in terms of realization is improved, but in terms of the margin, they are slightly lower, which is also impacting. Besides, obviously, the mix which talked about in terms of selling more tractors in the less than 40 HP category with informed track, like we mentioned, we have introduced tractors in the sub 40 category, which are the segment we are not operating in. So that is also impacting the margin, besides the mix of farm track and power track slightly, which is slightly skewed now. If you look at quarter on quarter also, it's about 1% swing which has happened, which is also impacting the margin. So it has led to actually all these material cost increases happening if you look at quarter on quarter.
Okay, and the price increase which we have taken?
So we've taken roughly 1% price increase in this quarter, but that was taken after the season was over, so by end of November.
Okay, and have we taken anything in Jan?
No, so there's no price increase in Jan. So as of now, we don't see really much impact coming in from the inflation or the commodity prices softening. So we don't see really that pressure will continue going forward.
Okay, okay. And can you update us on the dealer inventory going into Jan and the demand which we are seeing in Jan? Is there any change in the trend?
Yeah, this is Shenu Agarwal. So as far as dealer inventory is concerned, we have spoken about it previously also, that in number of days we have substantially reduced dealer inventory in the last about, let's say, 3 years. And I think right now we are sitting at the best dealer inventory, which means the lowest dealer inventory in terms of number of days. Right, so yeah, so I think we will continue to kind of be at those levels, and we feel that probably in the industry we should be at the best when it comes to number of days of dealer inventory right now.
Okay, so dealer inventory would be what, about 4 to 5 weeks or lower than
that?
that?
No, it will be much less than that. It will be close to 3 to 3.5 weeks.
And update for the Jan month, has demand picked up?
So December and January are looking pretty much the same, right? So I think there will be more pickup in the demand from absolute demand from March. But overall, this quarter 4, as we had earlier said, would be kind of 0 to 3% growth in the industry. And the main reason is because of the high base last year, because last year the industry grew in Q4 by about 49%. Right? So we are sitting on a high base, and that is the reason that this time we may not see that much growth in the industry in Q4.
Sure. Thanks and all the best.
Yep, thank you.
Thank you, sir. We have a next question from the line of Hitesh Goel from Kotak Securities. Please go ahead.
Yeah, thank you. My first question is on the RM cost. Like you said, the RM cost has started to decline from December onwards. So do we see any benefits coming in the fourth quarter? And so basically, how are our contracts structured with the vendors?
Yeah, so normally we have a benchmarking which normally goes with a lag of about a quarter. So any impact in this quarter will get reflected from the next quarter. So any change which has happened in the December quarter obviously will be effective from 1st of January. But the softening of price which will happen in Jan to March quarter will get reflected only from 1st of April.
Yeah, so December actually the commodity cost have declined. So we should see some benefit coming through in the fourth quarter, or it should be in...
So we look at the weighted average of the quarter. So if in October, November they were high and December it's gone down, so that may not really have much impact positive in this quarter. But yes, we expect early April onwards it will look better.
Okay. And, sir, any issues which has happened on tractor demand because of NBFC issues? Also, Mahindra Finance in their call was saying the tractor demand is very buoyant. And you are saying we are expecting only 0 to 3% growth in 4Q FY19. So, can you just shed some light? What is there any financing issues in the industry? What is the basically scenario right now?
Yeah, this is Shenu. So I don't think there are any, we haven't felt any issues with respect to financing. I think the credit is abundantly available. There are no red signals from any financiers that we work with, and we work with most of them. So I don't think financing is going to be an issue. We also, on to your other question about what Mahindra said, I think our estimates for the whole year are about the same. So I think in quarter 4 probably we both are talking about the similar kind of industry growths.
Okay, great. Thank you. All the best.
Thank you.
Thank you, sir. We have next question from the line of Gunjan Prithyani from JP Morgan. Please go ahead.
Yeah, hi sir. Thanks for taking my questions. I just had a clarification on this industry growth. Now, clearly when you spoke last time, you were guiding to a higher growth for the industry, and this seems to have come off in the commentary that you gave now. Is there any change that you're seeing in the underlying demand, and you think F20 growth could be pretty soft? And also the subsidy business that you spoke about. Now, are you seeing the roll down in these subsidies, which is kind of having an impact on the overall volume numbers for the industry?
All right, this is Shenu again. So see, as we explained on the last call also, I think we maintain that view that there are no fundamental actually factors that are affecting the industry right now as far as we are concerned. Right. So when we talk about availability of credit or the sentiment at the ground, these are all positives. Although there are some worries about lower sowing of the Rabi crop, right? But we don't think that is going to impact the industry too much at this point in time, right? And whatever negative impact has come in sowing, that has largely come in the south, where we traditionally have a lower market share. So at least Escorts won't get affected by it too much. So as far as the estimate for the whole year we had given earlier, that is right. We had said we will probably see industry growth of 12 to 14 or 15% for the whole year. But now we are saying about 10 to 12%. For the whole year. So there is a couple of percentage of drop that has factored in the last couple of months. And that is probably because of, slower growth than we were expecting in November and December. So we think that will continue. As far as Q4 is concerned, there is not a major change. I think we told, earlier also we gave an estimate that because of the high pace last year in Q4, the industry may not grow that much this year. So we are revising our estimates to about 10 to 12 now for the overall year.
And would you share anything on the subsidy business not with respect to Escort but industry, because that's been a key driver for growth in last year? Do you think that there has been some roll down in subsidies in certain states and that can have an implication on the growth?
No, I don't think there will be a roll down on subsidies. I think that actually, in near future, everyone is expecting governments to roll out actually more stocks to the farmers. And therefore, I think either in the form of subsidy or otherwise, I think there would be a greater support from the government side to the farming community, which would actually have a positive effect. So even in Q3 ending December, the industry benefited quite a lot from the subsidy-related sales.
Okay. And last question, anything you would like to share for 20 growth outlook?
Yeah, see that, as we said in the last call, I think we'll be in a better position to give you an outlook around, let us say, February or March about that once we have some initial forecast of the monsoon coming in. So I think that would be the better time to give a forecast.
Sure. Thank you so much.
Thank you. We have next question from the line of Mitul Shah from Reliance Securities. Please go ahead.
Thank you for taking my question and congratulations for a very strong performance, sir. Sir, my question is a follow-up on as you said that FY20 right now you would not be able to guide, but just broadly on the industry perspective, not from the Escorts perspective, that monsoon deficit is much higher in South and Western. And on the other side, barring just 2-3 players, most of the players are having inventory in the range of 5 to 6 weeks. So in that situation, sir, how do you see next 1 or 2 quarter at least from industry point of view for the tractor segment?
Yeah, so Mitulji, from industry point of view, I think there is going to be a very positive momentum in the industry, at least in the next 6 months going up to June or July, which is the Kharif kind of sowing season. We don't see any problems until then. The Q4 lower estimates are only because of the high base of last year, because as I said, last year the industry grew phenomenally by about 49%. So on such a high base, I think it is, we are not estimating a growth more than kind of 3 to 5% in Q4, right? But going forward, Q1, Q2 of next year should be pretty buoyant as far as we are concerned. Now coming to the west-south or geographical phenomena, you are right that in the last 3 to 4 months or maybe slightly more, we have seen north and east industry growing much faster than the south and west industry. Even in December, we had the same phenomena. And the reason is, of course, availability of water in those areas is not good. I mean, there are several areas in south and west which are kind of undergoing a drought situation. And that is not going to change at least until the monsoon, fag end of the monsoon. Right, so Escorts is certainly going to be benefited from all these factors because the industry is going to grow much higher in areas where we are much more dominant, and therefore, I mean, we are very confident that we'll continue to grow better than the industry as we have for the last 3 or 4 quarters now.
Yes, sir. My second question is on the construction equipment side. In MHCVs, we have already started seeing industry declining since last 2-3 months. So on the construction equipment side, how do you see in terms of the cyclical reversal and on the margin side outlook for next year?
I think if you look at the numbers for last quarter, there was some impact which happened because of the NBFC issues, and November really went very soft for us. So but from the last 2 weeks of December, we saw the demand again coming back. And normally we've seen the second half is normally the strongest quarter, and March typically is a very strong quarter for construction equipment business. So we expect again the momentum will continue. At least this quarter we expect it to be very strong momentum. Though for next year we expecting because some election coming in and there will be some stagnation which may happen for a few months. So there will be some temporary impact of 5-6 months. But still we expect the industry should give double-digit growth next year too. I think on the margin front we are given a guidance of 4 to 5% sort of margin range for construction for this year, which we very much expect probably will be maintained. So we've seen normally the maximum volume really comes in the last quarter, which probably could be a good quarter. So overall the margin will get improved, and that improvement we've seen happening in the last 3 quarters also. And for next year, obviously, the continuity to the improvement in margin will remain. As we said, we are moving up the value chain and also looking at selling the higher end products. So that journey should continue. So obviously, in the long term, directionally margin which we have given for a construction business, for example, FY2022 is about 8 to 9% sort of margin. And we are still talking about 4 to 5% this year. So obviously, there is a scope for improvement which we'll continue to work on going forward in the next 2-3 years.
Thank you, sir. Thank you for it.
Thank you, sir. We have a next question from the line of Prateek Rangnekar from Credit Suisse. Please go ahead.
Yeah, hi, good evening, sir. This is Jatin. A couple of questions from my side. One is you are right now at about an 11.5% market share. What is the market share aspiration you have for FY20? And what would be the main drivers of the same?
Yeah, Jatin, we have a few weeks to go, but we are very confident that we'll be able to achieve about, let us say, close to 12% market share in this fiscal year. We are already about 1.1% gain as compared to last month in the first 9 months, which makes us the highest market share growth player in the industry. And if we continue that momentum for the balance a few weeks, then we should be touching about 12% market share. As last year, our market share was close to 11 or 11.1. Now, from 12, a base of 12, we certainly aspire to repeat the performance of this year, which is about, let's say, 1% market share gain again. So let us say somewhere between 12.5 to 13 is what we are going to target for FY20.
Okay, that's good. Great to hear that. The question for Bharat on FY20 margin guidance and what are the key levers that one should look at for next year? We have spoken about there being a further potential to improve margins, so just wanted to check as to how quickly you are kind of looking to realize that.
Well, I think directly we are obviously still think there's a scope for improving margin further. So if you look at the benchmark within the industry also, so we think there's still scope which is left on the table. So this year, obviously, we have given a guidance of improving our margin by about 100 basis points. So though this quarter has taken slightly beating because of some issue which we had, though on YTD basis still we are better than that. And we expect by the end of next quarter, again for this full year, we should be actually meeting that guidance. So like Shenu said, so we have an aspiration to grow on market share as well as also improving on margin. So I think we are very much on target, I think on those directions. So we'll continue to work on that. So again, I think the plans for next year are still being finalized, so they can't really give any guidance as such specifically. But obviously the journey is towards improving margin further from where we are today. So that journey will continue, so we'll see improvement only happening next year too, as long as our market share gains and the volume sustain.
Okay, sounds good. Thank you.
Thank you very much, sir. We have anyone who wishes to ask a question at this time, press star and 1 on your touchtone phone. We have next question from the line of Nitesh Sharma from Phillip Capital India Private Limited. Please go ahead.
Thanks for the opportunity, sir. Sir, on the railways business, we've touched upon at various points that we are looking at inorganic opportunity for another leg of growth. So any update, where are we on those plans?
There are a few opportunities which are being evaluated as of now, but obviously nothing has been finalized so far. So obviously it takes a longer process to really evaluate and go through the entire process. So we are still exploring those options. So there are a few on the pipeline. So let's see, maybe in next 3-4 months if something materializes, definitely we'll come back to the market and inform you guys.
Okay. And on the construction equipment side, can you help us with what percentage of financing in CE would be via NBFCs?
Okay, you want me to take this answer?
Yeah, please.
Yeah, NBFC is about 80%. 80% of the equipment are generally financed offered by NBFC.
90%, if I hear you correct.
Yeah, 80%, 85% around about.
So 80 to 85% is solely NBFCs, or it's a mixture of both banks and NBFCs?
See, basically, if you see, ask me, the Shrey is the biggest, and then you have the HDFCs and Shriram. Those are the guys who play a bigger role in construction equipment. So I would say, 80 to 85% is getting financed by NBFCs as of now, as far as our equipment is concerned.
Okay, and despite such a huge chunk being financed by NBFC, we haven't seen a major impact on demand per se as compared to something like an MHCV segment which saw a bigger impact.
Yeah, I won't say that because there is some stress. There is some stress in the liquidity situation. But they are getting offset by some strong players which are coming in between. Like HDFC is coming in a big way now.
Okay.
So that is taking care of much of the slot which has been left by Shrey or other smaller ones.
Okay. Got it, sir. Thank you. I'll come back in the queue.
Thank you, sir. We have next question from the line of Shashank Kanodia from ICICI Direct. Please go ahead.
Good evening, sir. So I just wanted to ask, in terms of September at quarter end, we had some stretched working capital cycle resulted in some short-term borrowing on our balance sheet. So what's the status as of date?
So as I mentioned, our total debt as of the end of December stands at about 239 crores, which is slightly up compared to the September quarter, because we had entered into a high festive season this quarter where the growth was very high. We've grown 34%, so obviously the dealer's working capital also is reaching a stretch. So which is leading to some build-up happening on account of inventory and data on our books too, which has actually impacted this. But we expect, I think, by end of March, we should be falling in line. We should be back to the normal process.
Okay, so what kind of short-term borrowings will end by March 19? So
by March, we expect it should be back to in the range of about 100 to 150 crores sort of range for the working capital side.
Okay. So, sir, then we should be generating in excess of 300, 350 odd crores of cash flow from operations, right, this year. So, how do we intend to spend that?
I think if you look at the overall cash flow cycle, obviously there's some capex obviously which has happened besides the loan repayments. So 40, 45 crores of the long-term loan which are getting repaid, and there were 150, 160 crores sort of capex which has happened. And on top of that, this major money which has gone in two factors. One is obviously the high tax flow which we have, which we already have taken care of. And then they got some accumulation which you're facing happening on account of GST. Now, as you know, the tractor industry continues to be in the inverted duty structure regime where your input taxes are higher than output tax. So as a result, there's some accumulation which has happened for which the refund process is still on, and the government hasn't really streamlined that process. So that's the result. We also have huge amounts stuck in GST accumulation, which is awaiting the refund from the government. So we expect if by March, we expect that refund process to continue to start. Then slowly we should end up a better situation. Otherwise, if the thing get delayed further from the government side, then obviously there is some pressure on the borrowings too, on the working capital side. As of now, we got close to 130, 140 crores, which is due from the government as refund on account of GST. So major borrowing, you can say, has been attributable to actually one of the reasons is also that.
Okay. So what will be the CAPEX guidance for FY19 and 20?
So FY19, we expect the cash flow wise, it will be somewhere around 150 to 160 crores. Though next year, like I said, the plans are still being formed up. But we expect it will be anywhere between 250 to 300 crores total requirement.
Okay. Fine, sir. And so lastly, on a dividend distribution policy, if you can throw some light.
So dividend distribution policy, if you can look at our website, so recently we uploaded a revised policy, only I think about a week ago. So which actually looks at distribution improving, and there's a band which has been defined. Within that, we'll be really looking at the growth factors and other initiatives. So obviously the idea is to improve as the cash flow improves, so the distribution will improve, and within that band which has been defined in the fund.
Fine, sir. Thank you so much, and wish you all the best.
Thank you.
Thank you, sir. We have next question from the line of Amin Pirani from Deutsche Bank. Please go ahead.
Yes. Hi, sir. Thanks for the opportunity. So my first question is, just going back to the FY19 volume growth expectations for the full year. Now, while, I appreciate the fact that, 4Q is a significantly high base, to be very honest, this is something which was, well known, but still, not just you, but other participants in the market also have had to reduce their, full year forecast, say after October or November. So, is it just because festive sales was not, as per what earlier the growth was expected, or is it just, just a marginal, correction in the guidance? And my second question is, your market share gain this year, how much of it can be attributed to market share gains, in individual regions, and how much is it just a mix? Because obviously I think the areas where you are weak have not grown as well. So, mathematically you should have seen a market share improvement anyways.
Okay, so let me answer the second question first. So there has been a benefit of the mix in terms of the overall market share, but that is limited to only about 0.2% or 0.25% out of total of 1.1% in the 9 months. Right, so the rest of it has come from individual state market share increases. Now, for example, on YTM basis in Haryana, we have increased more than 2%. UP and MP is more than 1%. UP is like close to 1%. So is Gujarat, Northeast, Odisha, Maharashtra, Karnataka, Tamil Nadu. So all these states we have increased market share substantially, most of them above 1% and sometimes even above 2%. Right, so there are only like 3 or 4 markets or states where we have either retained or lost market share. Otherwise, in most of the markets, we have gained market share. So that is, I think, the answer for the second question.
Yeah.
The first question is that, the answer to the first question is that, see, there is no substantial change in the Q4 actually estimate. I mean, from the very beginning, we thought that the Q4 industry won't grow beyond 5%, and right now also we are saying something between 3 to 5 maybe, right? But mostly it is like the seasonal sales, which we thought will grow much more than it actually happened, right? I mean, our growth was pretty substantial even in the season, but I'm talking about the industry right now, and the industry did not grow that much. I think one of the factors was also that we did not probably consider in our estimate was the inventory levels with the competition. Which we were a little bit surprised that they were sitting on such a high inventory getting into the season.
Okay. Great. Thanks for this.
Thank you, sir. We have a next question from the line of Bharat Gyanani from Sharekhan. Please go ahead.
So thank you very much for the opportunity. My question is that you guided for capex of about 150 to 160 crore for this year, and for FY20 you have guided for 250 to 300 crore, right? So what would that capex be to? Because I was just trying to understand, is it through to some joint venture, or like where is it exactly capex going for in FY20?
Practically, if you look at our earlier guidance for the FY19 capex, we had given a guidance of 300 crores capex happening in this year. Out of which major portion was 100 crores, which is going in setting up the capacity for our machining center, which is about 100 odd crores. So that process, the orders placement has happened in this year, but the cash flow which is supposed to happen this year has got delayed to next year, now, which is a major investment which will happen. So roughly 80-90 crores will get spent daily on that account only next year. And then obviously going forward, we have some product development plan which are already there. So we already been indicating a capacity expansion which will be happening now. So JV obviously will be segment over and above this the investment. So we already have this announced. Kubota will have investment of close to 300 crores, out of which 120 crores, which is 40%, will get contributed by Escorts, which is over and above this capex which will happen. But on the capex side, there are product development plans which are in place, both across all 3 segments, whether it's a railway or it's a construction equipment, as well as for the tractor business. So we expect, I think, because the spillover which has happened from the current year to next year, so the capex overall guidance will remain in that range.
Okay, so this machining will help you to improve your margins, is it like, or how should we get into that?
The machining will help us in improving capacity. So I think one of the reasons which we are facing today is the working capital issue, because the high inventory build-up internally which we have to do to plan for the high seasonality volumes happening in few months. So for example, typically we've seen very high volumes in September, October and November months, and our capacity was not really in line with those numbers. So we had to carry inventory for a large number of months, which actually impacted the working capital cycle, which is the same situation we are probably facing now, if we have to plan for the next September-October season, which again we are expecting will be good. So that's something which is actually impacting us. So once your capacity is set, we expect the production level probably will improve in those months, so we'll need to carry lesser inventory. So overall there will be good impact on the cash flow side. Your borrowing level will likely come down and lead to some positive cash flow happening here.
Okay. And sir, my last question is that any update on the treasury shares you would want to give, like as for some acquisition or JV you had I think 2 or 3 quarters back sold some treasury shares. So any update on that for, like, you alluded to some investment opportunity in railways. So any thought on that you would like to share at this point of time?
I think first of all, like in this year we announced 2 joint ventures. So one on the construction equipment side with Todano Limited, which is for the high-end crane, and second with Kubota for the tractor business, where again both the JV will need initially capital of almost 170 to 180 crores. which obviously will go from the sale proceeds which we have accumulated from the treasury stock which we sold about a year ago. And going forward, like you said, the railway, we have some deals in the pipeline which are getting evaluated. Obviously, if the deal materializes, then there will be requirement of cash, which obviously will get used from this. And if for any reason there is a higher requirement, if depending on the valuation, would be really finalized for that particular transition. So there may be need for further. So we expect that need fully will be addressed with the kind of accrual which we expect will happen on the cash generation, which we expecting to happen in next year. So we don't see in the short term there will be a need to really further dilute the shareholding and sell more shares. But obviously, it will all depend on what sort of deal we really come on the table. So as of now, it's very difficult to quantify that amount.
Okay. Okay, sir. Thanks and all the best.
Thank you. We have next question from the line of Raghu Nandan from MK Global. Please go ahead.
Thank you, sir, for the opportunity. Sir, my first question was on the new products. For the last quarter, the new products, that is the Atom tractors and the Rice Specialist tractor, can you share how has been the sales and how is the outlook going ahead for these products?
Okay, so for the Atom, in last year in Q3, I'm just talking about last quarter to this quarter. Last year in Q3, we did not have any sales, and this time we are touching close to 200, which is about 60 to 70 a month. Of course, there is higher potential, but as I explained in the last call also that there are a couple of reasons that we are going slow with this, because this is a completely new platform and a completely new kind of category of tractor that we are producing, and therefore we want to make sure that the tractor is seated well in the markets before we scale it up. In 9 months of the year, last year, of course, we did not have any sales, and this year we have done just over about 500 tractors on the Atom. And same situation is with Paddy tractor, Paddy Special, that we have now spread it into about 4 or 5 states. We started with a couple of states, but there is a great acceptance of this as well as the Atom, and therefore we are now slowly spreading it into other markets. For example, Atom we have also now given in J&K for orchards, etc. Some of the tractors we have given to some orchard markets in MP. So we are moving out of Maharashtra for Atom and out of Orissa and AP for the Paddy Special.
Understood, sir. And what was the volumes for Paddy Special?
I don't have those right now, but I think maybe about couple of hundred for the 9 months. But I will have to confirm that to you.
And so, initially we had launched it in the 47 HP segment. Any plans going ahead to expand the product range and bring in more products in that segment? Because as I understand, it's a 1 lakh unit market per year.
Yeah. So see, this is a 4-wheel drive tractor. The Paddy Special is not a traditional 2-wheel drive tractor. So the market that you just mentioned is like the total market of 2-wheel drive and 4-wheel drive. Right? We want to enter the market from the top end side with this tractor. Of course, we have other 2-wheel drive tractors, the traditional tractors that we also sell in paddy markets, right? So it's not just that only with this tractor we are kind of addressing the paddy market. But of course, this tractor is much better suited for paddy, and that's why it is called a Paddy Special. Other tractors are like more general purpose tractors. So the ideal tractor for paddy is about 45, 46, 47 horsepower. So right now we'll just go with this one, and will not spread ourselves too thin, but try to scale this up into better volumes.
And sir, in the coming months, what are the plans on the product launch side?
Yeah, so see, we have launched a few more kind of products in this quarter, but they are not kind of category creators, but they are kind of products which have filled some minor white spaces in our portfolio. Or have added some extensions to the current products, right? So that is one. But there are a couple of major launches that are slated for next fiscal year. There is one on the power track side and one on the farm track side. I can't kind of divulge any details right now because of confidentiality. But there are going to be a couple of mega launches next year. One from power track and one from farm track.
And do you expect the share of power track to keep increasing in the portfolio?
Yeah, see, in the last few months or quarters, actually, farm track has also started growing quite a bit. Especially in this last quarter, farm track also had a reasonable growth as far as market share is concerned, and of course volume. So PowerTrack will for some more time grow faster than FarmTrack, and the reason for that is because PowerTrack caters to almost every kind of district or market in the country, while FarmTrack is quite limited in its geographical coverage as of now. So once we start expanding FarmTrack distribution network into areas where there is no network for FarmTrack right now, then FarmTrack will also catch up with the rates of growth that PowerTrack is enjoying right now.
Understood, sir. On the agri side, we had been taking some cost reduction efforts on the raw material cost. Have all the benefits come through, or how much more is left to come on the cost reduction?
See, cost reduction is quite a continuous journey, and you would have seen that in the last 3 years or maybe like more, 5 to 6 years, constantly we have been achieving significant cost reductions in our material cost through various programs. So going forward also, we will continue to do this. I think normally on an average, if you see, we do gun for about a couple of percentage on the raw material cost, not on the sales value, right? So I think that trend we will continue to kind of achieve even going forward.
And sir, on the employee cost...
Sorry to interrupt, would I come back in the queue?
Sure, I'll come back in the queue. Thank you.
Thank you. Participants, kindly restrict your questions to 2 per participant. We have a next question from the line of Chirag Shah from Edelweiss. Please go ahead.
Yeah, thanks for the opportunity and congrats for good set of numbers. Sir, I have a question on financing. Can you indicate what kind of rate increase that have happened of late because of this NBFC issue, both in construction equipment and tractor market?
This is Shenu. Ajay can comment on the construction, but on agri, we haven't seen any shift in the rates because of this issue. As I have clarified in the previous call also, we have had no signals from the NBFCs about any anxiety around tractor financing at all. I think one reason could be that it is priority sector lending for banking, and also the other reason is that the portfolios are pretty much in good shape as far as tractor financing is concerned. So there has been no or insignificant shift in the rates because of this issue.
And,
as far as tractor
even loan to value ratios would have been largely stable.
Loan to value ratio have been improving a little bit actually. So earlier, like on the KYC base of financing, most of the banks would hesitate going beyond 65 to 70%, but I think slowly we are reaching close to like between 70 and 75% now on KYC-based financing.
And on the construction equipment?
Yes, no change in interest, as I said, there is no change in interest, and LTVs are at the same level, 75 to 85% depending on the case.
Fair point. And so one last question, if I can squeeze in, is on the replacement tractors or the used tractors. We are reading that there are some issues cropping up in the used tractor market. Are there any signs you are seeing, or these are one-off cases that the farmers are not able to dispose their older tractors, and then the chain is now getting affected?
No, we haven't seen anything like this. I think this could be a one-off news from somewhere. In fact, our used tractor stock at our dealerships in terms of number of days is at its lowest level ever.
Okay. And just a clarification, you indicated 3.5 weeks is the inventory with dealers.
Yeah, give or take, yeah.
As on December. And this is a normalized... Is it a normalized inventory, or it's on the lower or the upper end of on the side?
It's about normalized.
Okay, thank you, and all the best.
Thank you, sir. We have next question from the line of Prayesh Jain from Yes Securities. Please go ahead.
Hello. Yeah, congratulations, sir, on a good set of numbers. What would be the share of spares and implements in your revenues for the 9 months?
To 8 to 9% revenue
that would...
non-tractable.
Okay. And could you throw some outlook on the exports for the tractors business?
On exports, like we had given a guidance that we were targeting to do close to 3,000 non-tractors this year. So, looks like we should be in line, so we should be able to really reach there. And then obviously next year, as of now, so for long term, we've given an aspiration of touching 8 to 10,000 tractors by FY 2022. So obviously we are looking at good growth opportunities happening there in the next 3 years.
So which particular geographies that you're looking for growing at a much faster rate?
So this year, for example, Europe has really helped us in growing our volumes, so which we have opened. So even this new launches which we've done in the compact tractor segment is helping us in getting good volumes on exports. And obviously, as geography, like a focus has been on Southeast Asia, Africa, and European countries, Mexico, Brazil, and North America. So these are a few continent countries which we're focusing on.
Okay. All right. Thank you so much.
Thank you. We have a next question from the line of Abhash Poddar from Infina Finance. Please go ahead.
Yeah, hi sir. Just had one question. Just wanted to understand how is the discounting been? Typically, when you have a slowdown in the growth, you see higher discounting. So just your thoughts on discounting, what has gone through in Q3, your expectations on Q4 as well, YOY comparisons, that would be helpful.
Yeah, so it's hard to give a generic answer to this because, I mean, different players have different strategies about discounting. I don't want to name any specific players, but there are one or two who have resorted to some extra discounting in the last few months. But I think more or less, I would say the intensity, competitive intensity is pretty much the same as we had seen in the last 3 or 4 quarters. So there's no big shift.
Okay, so for you as well, sir, for Q3 and Q4, the discounts YOY would be comparable and that would have not gone up too much, right? Would that understanding be correct?
Yeah, that is kind of right. Between Q3 and Q4, the discounts may go up slightly with respect to Q3, but then in last year Q4 also the discounts were a little bit higher because of the year end. So, but there will be no significant shift in the discounts.
Okay, sir. Thanks and all the best.
Thank you. We have a next question from the line of Jinesh Gandhi from Motilal Oswal Securities. Go ahead.
Hi, sir. My question pertains to tractors. You've talked about increasing contribution from subsidy sales in third quarter. Would you be able to quantify that either for industry or for Escorts?
I don't think we would like to give subsidy numbers separately right now. But you know that Escorts has not been participating in much of government-related sales or subsidy-related sales so far. And this is only the first time that we have started taking a dig at it. So one of the states had a large subsidy program, and Escorts participated in that this time for the first time, and we bagged the lion's share of that kind of state subsidy-led sales. Of course, subsidy-led sales comes at a slightly lower contribution or margin than our regular retail sales. But it does add to our market penetration and our market share growth and volumes.
Okay, and any reason for change in strategy on this thing, on subsidy-related participation?
Yes, part of our Vision 2022 15% market share plan. We have one of the levers is also to participate in government-related sales. Because if we have to do 15%, we can't leave a major chunk of the market out. Right? And as somebody else was also saying that subsidy-related sales and the absolute volume has achieved a meaningful kind of a proportion out of the total sales, total industry sales. So on case-to-case basis, we are making our decisions. We're looking at profitability that state offers in such schemes and the kind of volume that we can derive. Right? So, for example, we did participate in Assam subsidy-based scheme, and as I said, we took a lion's share of kind of that volume.
Okay. But for industry, it would be a sizable chunk or not really?
See, we think this fiscal year would be close to about 10% of the industry would have gone to government or subsidy sales-led sales.
Okay. Understood.
Yeah, so let us say about 80 to 90,000. It's very difficult to kind of pinpoint a number here because there are different variety of subsidy sales. Some are real subsidies and some are like very, very normal kind of subsidy programs. Right, so, and some are directly supported and some are supported indirectly, right, but more or less about 80,000, let us say, for the year out of 800 plus thousand industry for the year.
Understood. Great, sir. Thanks and all the best.
Thank you, sir. We have a next question from the line of Raghu Nandan from MK Global. Please go ahead.
Thank you, sir, for the opportunity again. Last time I was trying to understand, like on the cost reduction effort side, any levers left on the employee cost reduction, any plans to restart the VRS programs?
I think we had indicated last time also that VRS program obviously has been put on hold now, so we don't really want to go beyond a point because then financially it doesn't really start making sense. But if you look at overall number, I think if you look at this quarter number also in terms of manpower cost, I think we are very much there. I think it's close to 7.2% sort of manpower cost which we reported in this quarter. So as long as we are able to maintain the top line growth, which is what I think the focus has been, so we think the manpower cost will fall in line. So the efforts have been internally to obviously affect the cost at the level which we were, I think more or less at the last year's level. And we hope the same efforts will continue next year too. So I think the industry average has been in the range of 6 to 7% sort of manpower cost, and we are almost reaching there now. So I think beyond a point it will become difficult to really squeeze it further, but we expect maybe another year or so Kali will give us another shot, and after that we think it should get stabilized at those levels.
Sir, on the investment timeline on Kubota and Tadani, what would be the investment in FY19, FY20? Would it be something like 50 crore this year and the next year 100 crore out of the total 150 crore to be invested?
So this year we expect Tadano has already happened, so it's about 30 crores injection which has happened there initially, and only in the next 8 to 10 years plan has been about 150 to 200 crores sort of investment for that JV, out of which our share will be about 49%. For Kubota, we expect the first funding will happen probably sometime in this quarter, say by end of February or middle of March, so which will be initially about 60 odd crores, and then the second round will happen in the next fiscal, in FY20, so total 120 crores injection will happen there. So overall between these two JVs, it will be close to 150, 160 crores investment between current and the next year. And obviously going forward, then depending on the requirement, how the capex requirement pans out in those JVs, look at that option.
And so what is the 9-month capex?
So 9-month capex, so far cash flow has been close to 110, 115 crores.
Got it, sir. Thank you, sir. That's all from my side.
Thank you, sir. Participants, kindly limit your question to one per participant. We have a next question from the line of Sameer Deshpande from Fairdeal Investments. Please go ahead.
Hello, sir. Congratulations for the excellent numbers, and you have been doing it continuously over the last 2 years. The growth has been maintained very well. And if I look at the tractor figures for the 9 months for this year, our sales have been about 25% growth over the last year. And I think it is double the industry average growth.
Yeah, that's right. The industry growth is about 13%, so our growth is 25% so far.
So definitely it is commendable. And now our markets, particularly North, East and Central, not affected by the rains in adverse way to a large extent, will help us in Q4 also. So now I heard that the Q4, we are mentioning that the Q4 being a higher base, the growth may not be as high as 20-25%, etc. But if the industry is expected to grow at around 3 to 5%, if we continue with the same standard for the last 9 months, do we expect a double-digit growth at least in the Q4?
So if you're talking about Escorts per se, so I think what we talked about was the industry number obviously for next quarter. So obviously like Shenu mentioned earlier, so our aspiration is to grow further on market share. So obviously if that has to happen, so we have to grow better than the industry. So if the industry grows at 3 to 5% level, obviously we are looking at doing a double-digit growth in next quarter too. So, but obviously, so I think the overall sort of growth which you've seen happening in the last 9 months, so that may not be possible in Q4, though I think our outlook still remains bullish for the next 6 months on this tractor industry volumes.
That I understood. So at least a double-digit growth is expected in the Q4 also. That is good to hear. And this railway, we have an order book of 450 crores, which is also a record, if I am correct. So what is the period of timeline for execution of that railway order?
So timeline we mentioned is about 13 to 15 months. So this 450 crores is the order book as of 31st December. So though subsequently we got further orders. So if you talk about current position as of today, so they are sitting at order book of 500 crores, more than 500 crores actually as of now. So the order book is pretty healthy. So we expect the execution is now I think the key. I think it will happen over next 13 to 15 months.
So congratulations and all the best to you going forward.
Thank you.
Thank you, sir. We have next question from the line of Shashank Kanodia from ICICI Direct. Please go ahead.
Yes, sir. Thanks for the follow-up opportunity. So I just wanted to understand our product profile in the railway equipment space. So with the new age trains which runs high speed, so does our content per vehicle increase or how does it go about?
This is Dipankar. Yes, with the new age train like the Train 18, the first Train 18 we do not have a product out there, but in the subsequent Train 18 we do expect to have our products with a collaboration with our South Korean partner. Obviously, this high-end trains will have high-speed brake systems, which we have already geared up for supplying to railways and also to the metros.
So as we grow on our product range, obviously the idea is to have a better share of pie of the overall component industry within the space. So both on the wagons and coaches and locomotives front. So that's what we have been working on, and that's what Dipankar has been trying to do.
Okay. Fine. And sir, what's the growth rate that we can expect next 3 to 5 years, given that railway is on a big expansion capex mode?
We still maintain that we should be growing at the rate of at least 20 to 25%.
Right. Wish you all the best. Thank you so much.
Thank you. Thank you very much, sir. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Madan for closing comments. Sir, over to you.
Thank you, ladies and gentlemen, for being present on this call. For any feedback or queries, please feel free to write in to us at investorrelation@escorts.co.in. You can also visit our website and social media pages for the latest company news, development, etc. We'll meet again the next quarter. Thank you very much and have a very good evening.
Thank you very much, sir. Ladies and gentlemen, on behalf